I saw one pretty famous tech luminary, an American, actually one of the people who created the first internet browser back in the late '80s, early '90s. So he's seen a .com revolution, and he said this was our Sputnik moment.
It's January 28th, 2025, and welcome to the 22nd edition of Barnes Quarterly. It's hard to believe that we've been on air for this many quarters, but we appreciate your listenership, and hopefully we can deliver some good information to you. I wish everybody a happy new year. It's this time of the year, obviously people's minds start turning to you maybe are a little worn out from the holidays, but you don't have time to be worn out for too long because it's your CPA is going to be calling you about gathering your facts for tax time. And we also have kind of gotten a couple of questions on the retirement theme. We have some clients that are either nearing retirement or going into retirement or thinking about retirement. And as it relates to retirement, two areas are a focus. One being Social Security and when you should take Social Security. Should you take it early? Should you take it at normal retirement age, or should you defer it? And so we do have the capability to help you sort of sort through what your options are and what might be the best option for you specifically. And then secondly, the other area is distribution planning. I had a client send me an article from the New York Times that sort of addressed once you do decide to retire and begin taking money from your retirement accounts, which account should you begin to draw down on first? What other aspects of that distribution phase of your life should you consider? One other area is sequence of earnings. If the market sells off, what should you do about taking money out at that point in time? Obviously, it would be better if you could pare back your distributions or alternate to another account. How much should you keep liquid? So in the areas of Social Security planning and distribution planning, we can definitely help you work through that if you're at that phase. I know that's not relevant for everybody that's listening in, but it certainly is for a pretty large sector. Just to quote that article from the edition of the New York Times, America's hitting a phase some experts call peak 65, with more than 4 million people turning 65 in 2024, 2025, and 2026. According to one survey, it's an average of 11,200 people every day each of those years. So that's a lot of people that are having to face these decisions, and we would be happy to help you with those if it's appropriate. On a personal note, we did have our second wedding of the year in the Barnes family. My daughter Colson was married in New Orleans, Louisiana at the end of December, and so we were able to check both boxes for my son and daughter. Both are legally married to people that we really love both them and their families, and so it was a more joyful time even than usual for Christmas around the Barnes household. Eddie, I know you're sort of at a different phase of your life with regard to your kids, but I know that you took a big trip with your daughter Charlie up to New York. Why don't you tell us a little bit about that?
Yeah, hopefully I'm a long way away from paying for a wedding. But yeah, my daughter has a birthday at the end of the year, and so we decided to take her on a trip up to New York. She's never flown anywhere or been anywhere big like that, and so she has been wanting to go see some shows. She loves that kind of stuff, and so we went and saw a few shows and saw the sights around New York, and she had a blast. Got all the attention to herself, and was able to see a lot of the things that she's seen on TV, many times before. But ironically, she was hoping to see snow while we were up there, and had to come all the way back home to be able to see that.
Yeah, we had the blizzard of 2025 here in Tallahassee last week. One other thing that I would just mention, since we had some downtime over the holidays, I tend to be a podcast listener, not just the Barnes Quarterly, but two podcasts that I've really enjoyed listening to that I'll recommend to the listeners out there. One is a podcast called Acquired, and it's two gentlemen that basically do they'll take a publicly traded company and do a very deep dive into how the company was started, challenges that they've had along the way, what led to their success. But they picked some of the ones that I've listened to are on Starbucks, IKEA, Microsoft, Mars Candies, and Taiwan Semiconductor. But these two guys are typically their podcasts are about 3 hours. So maybe if you're on a long road trip, you might listen to the whole thing, but you might listen to it in a couple of installments. But they do an excellent job. The other one is by a couple of British guys, and their podcast is entitled "The Rest Is History." And so they take different historical events in time, everything from the build up to World War II to the civil rights movement here in the United States, and go into a lot of detail, not just about the events, but the characters involved in those events. And so anyway, if you're driving down the road or have some time behind the wheel, and want to listen to something that's entertaining and educational, I think those two are really good options. Well, Chris, welcome back to the podcast. Hope your holidays were good ones and you got rested up, so you're fresh for the new year. How did you spend your holidays?
Yeah, thanks, Dan. It's great to be back as always. Spent Christmas with my family, which was really nice, and then actually we were able to do a family trip, extended family, with my parents and brother and sister and their families. We went down to Aruba for a few days, so that was really nice. We kind of beat the cold.
That does sound nice, particularly since we had a very rare occasion here in Tallahassee with a couple of inches of snow. So Aruba's sounding pretty good right now.
Snow is crazy. Can't believe it. But you know what? If you've been around long enough, you'll see it all.
No doubt. Well, obviously it's already, we've kind of gotten off to a fast and furious start here in 2025. We've got a new president. We've got a new year. And would like to, obviously this week has been sort of eventful, kicked off yesterday with some kind of crazy stuff in the tech sector. You want to talk about that for a minute?
Yeah, absolutely. Taking a step back, clearly we've had 2 very good years in the stock market as far as much better returns than we expected. I think there's a lot of optimism coming into this year in terms of the opportunities for deregulation, tax cuts, along with some concerns about how tariffs would be used. Would they be used more as a negotiating tool, or would they be used more as a blunt instrument? But we were very surprised coming into this week, and we're recording this at the end of January, with the news out of China with their new artificial intelligence capability. And it really caught a lot of people off guard, myself included. I know they had said for a few weeks before this weekend, there have been some rumblings or some examples of some of the things they've been able to do. But really, the news surprised a lot of people in the sense that it seems like despite a lot of the export restrictions that we had on the NVIDIA semiconductor chips that are used in a lot of artificial intelligence applications, they were able to use older versions of NVIDIA chips and in a much less expensive way come up with a result that a lot of people thought was pretty similar to what the best capabilities we have here in the United States. So it was a little bit of a surprise. And I think not only did a lot of the artificial intelligence companies see a big drop in their stock price, but even some of the tangential plays, such as utilities, nuclear power, a lot of the things that you would expect would go along with increased power usage and/or spending on artificial intelligence. So it was a very big surprise, and the market really showed in its pricing how surprised it was with some pretty big drops on Monday, January 27th.
Well, I mean, I wouldn't say that we can brush it off, but I mean, I don't know how much detail has gone into analyzing how good their AI solution is, or whether it's sustainable or full of bugs or anything else. It was just kind of seemed like a pretty superficial news item that had pretty significant negative impact in that one day. We've obviously, this is Tuesday as we're recording this, and have had some recovery there. But I've always heard that China, they're very good at duplication, but they're not very good at innovation. I don't know what your thoughts are about that, but is this, you think this is a sea change, too early to tell, or just something kind of a blip on the radar?
Well, I think, it'll obviously take a little bit longer for all the facts to come out. You rightly point out a lot of questions. Were they able to do this as cheaply as they said? Were they truly using the degraded chips, or do they somehow have the ability to get the better performing chips? How did they do this? What other money was spent and time and effort beyond just what was documented? So I think there's still a lot of questions out there. And you're right. I think historically speaking, we've looked at the Chinese economy and a lot of their companies as really either stealing U.S. Intellectual property, or just being very quick to copy what we're doing and duplicate. And so I think we've seen that a lot in the past. You could probably even look at what was said of the Japanese in the 1950s and 1960s in terms of them being very good at taking a lot of American innovations and then duplicating them, producing them much more cheaply. But over time, back in you go to the 1980s and later, the Japanese were able to develop a lot of capabilities where you could argue they were able to innovate. And so this is an interesting example, because on the one hand, they're copying a lot of what the United States has been able to do. Specifically, Facebook, Meta, has an open source, which means free and widely available model. So they took advantage of that. But they did do some innovations, not just in terms of how they produce their models, but also in terms of shortcuts or slightly different approaches. So we are seeing a little bit of innovation in this particular case. And so, time will tell whether or not, they're able to make very smart engineering improvements, or whether they can truly come up with brand new concepts. But it is a wake-up call for Silicon Valley, a wake-up call for really the U.S. tech industry. We clearly lead the world in a lot of different areas. We do have a lot of innovations. We have a lot of great universities and capital, but China is the second largest economy in the world, and they grew that way from manufacturing, in a lot of cases, maybe improving on things that they've seen around the world. But it's really a good wake-up call for all of us as investors, as consumers, as Americans, that we can't rest on our laurels. I saw one pretty famous tech luminary, an American, actually one of the people who created the first internet browser back in the late 80s, early 90s. So he's seen a .com revolution, and he said this was our Sputnik moment in terms of seeing a technological achievement, in this case from the Chinese rather than the Russians, but really kind of potentially light a fire under us. And so whether you want to make an analogy to the space race of the 50s and 60s, of which we ultimately did get to the moon first, as we all know, you could make a similar analogy to the artificial intelligence race. And it really does seem like artificial intelligence, computing power, and a lot of the things that we take for granted as consumers, but also are very important from a military point of view. Clearly we have another space race going on, to use that term.
Very good. Well, I know you recently did an interview with Maria Bartiromo on Fox Business, sort of talking about the outlook for 2025, and I'd like to kind of get at least some of your thoughts on I know that it's really too early to tell anything about what 2025 is going to look like. We just came off of a year where the S&P 500 made 25% for the year in 2024. But tell us, if you could, maybe just on a high level, sort of what some of the themes might be for 2025, and with with an eye to having Donald Trump as the president of the United States.
Yeah, absolutely. As I mentioned in the interview, I think there's a lot of positives in terms of reason for optimism in terms of the U.S. economy. Currently the economy is still producing at a pretty high level. We've had a lot of issues with inflation. We've had a lot of issues with quality of employment. It hasn't been an unblemished picture, but we're at least starting from a place of economic expansion. We're by no means in a recession. And we do have that opportunity for deregulation, potentially either preserving the existing tax rates or even lowering them in some cases. So there's a lot of tailwinds in place in order for the economy, corporate profits, and potentially the stock market to go higher. As I mentioned earlier, tariffs are a really big concern, not only for myself, but I think for all of the market, because again, if tariffs are used as a negotiating tool or as a temporary measure, then I don't think that's necessarily going to be an issue for the stock market, at least in the medium to long term. However, if we do get into a tariff war, if we do get into a situation where we start effectively a trade war with other countries, and there's a tit for tat retaliation in terms of them raising tariffs on our goods, all things being equal, that typically leads to lower economic production. It leads to challenges within at least some of our sectors. Clearly the exporting sectors will be challenged as tariffs are raised on their products overseas. And likewise, a lot of American consumers, we do import a lot in this country. And so to the extent that our imports become more expensive, it could become more of a challenge. So you're exactly right. It's too early to know whether or not we'll have a good year or not. But I think the broader themes are around some increased efficiency, potentially deregulation, and a tax code that should be generally favorable. However, we could see some issues around trade, some issues around tariffs. One issue that hasn't been brought up, but I think bears pointing out, and it's yesterday's sell-off on that January 27th sell-off as a good example, is that one of the byproducts of the stock market doing so well for the past 2 years is that we've had increased concentration. So if you look at the S&P 500, it's a market cap weighted index, which means companies that are larger in market cap in terms of what the stock market puts as their valuation have a larger percentage part of the index. Really, the index is very heavily concentrated within fewer companies. So if you were to look at the top 10 companies in the S&P 500, at some point you're between 35 to 40% of the index. So despite being only 2% by number, 10 out of 500, you're looking at 38 to 40% by weight. So clearly the largest companies in the index have a very disproportionate concentration within that index. And so on the one hand, if those companies are doing well and they're the larger tech companies, your Microsoft, Amazon, Apple, Google, and then some non-technology companies like Berkshire Hathaway or JP Morgan. But if you look at these 10 largest companies, if they're doing well, which they have in the past 2 years, it's great because you get a disproportionate lift in the index from fewer companies. But the reverse is also true. NVIDIA went down, I want to say 17% yesterday on Monday, January 27th. And so given that it is a significant weight in the index, that had an impact. You saw the S&P 500 go down around 2%. You saw the NASDAQ go down around 3%. So, it's a double-edged sword in terms of having concentration. And so, one thing that's worth watching is just making sure that, we as investors, we're diversified and we make sure that we don't have too much of our clients' money or our portfolios in any one particular company. Absolutely. But also making sure that we're careful in our own concentration and that we don't let one or two bad stories or missteps really cause problems for our whole portfolio. So that's really the value of what we're doing in terms of being actively managed and making sure that we're very vigilant with our our portfolios and with our clients' money.
Chris, what do you see happening with interest rates over the coming year? I know 6 months to a year ago, they were talking about several potential rate cuts coming. And then by the end of this past year, they had settled to, the one we had and potentially one more. Do you see that staying pretty consistent through this year? Or do you see things changing?
Yeah, so as far as interest rates are concerned, a lot of it will depend on many of the factors that we already talked about. To the extent that inflation was coming back down last year, that allowed the Fed to start thinking about potentially cutting rates much more aggressively, whether that was 6 times prior to the fourth quarter heading into 2025, or whether that was 3 times as we got later in the year. And to your point, we basically ended 2024 with a rate cut in December, and markets basically predicting that we'd only have one more in 2025. And so I think that's a good base case. I would expect, one rate cut, all things being equal. However, if inflation were to start ticking back higher, one reason for that might be tariffs. If they were widespread and that increases costs across the board, then you could see the Fed potentially not cut again for this entire year, or they could even potentially raise rates towards the end of the year. That's not something that I think is very likely. I think that's more of a long shot. So hopefully there's very little chance of them raising rates, but it's not outside the realm of possibility. Conversely, if we see an economic slowdown, either because of potentially a trade war through tariffs, which again would be a worst case scenario, or just through the normal business cycle. There's always unexpected shocks. You never know what's going to happen. And so, we can't predict the future more than anyone else. All we can do is really look at, what are the potential risks? What are the potential possibilities? And so if we were to see a slowdown that was unexpected, again, potentially you could see some inflation through tariffs. But if that was enough to slow down the consumer, and you saw a significant slowdown in the economy, and you saw the unemployment rate tick back up, then I wouldn't be surprised to see the Fed go ahead and cut rates aggressively. So, laying out the possibility of those two extremes, potentially not only not cutting rates, but potentially raising rates, which again, I would assign a pretty low probability to, or the case where we have unexpected turbulence and you see significant rate cuts. I think the one rate cut that you mentioned, and I think that the market's expecting, is a pretty good base case, because all things being equal, things continuing on the current path with what we're expected in terms of policy, and with tariffs that are used more as a negotiating tool or potentially surgically as opposed to across the board. I think one rate cut or maybe even no rate cuts is a likely scenario. So I do think the interest rate picture has changed significantly since last summer and has changed slightly since the end of last year. And that change has been from more rate cuts to fewer cuts.
Chris, thanks for being with us here today, and we'll look forward to continuing discussions as we move throughout the year.
Absolutely. It's been great speaking with you again and all the clients, and appreciate everyone listening to what we have to say.
Chris Saccarelli are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.